Good morning. I'm Rick Hough, Chairman and CEO of Silvercrest Asset Management. I'm joined today with Robert Teeter, our Chief Strategist. I thought I'd pick up on some of our prior conversations with regards to rapidly changing economy, especially with the new tariff negotiations that have been occurring now for some time and the volatility that has created in market outlooks in the economy. One thing in particular we want to cover is how does growth in the economy translate into higher accelerated earnings in actual investments in the stock market, real companies that can compound the results that investors see with their investments. Good morning, Rob. How are you?
Great, Rick. Good to see you again.
Good to see you. So the conventional wisdom, Rob, which we talked about and we had some concerns with as well, was that the tariffs, when introduced, would lead both to higher inflation and a slower economy.
Yes.
And we had everything from political observers saying, no, this is great for America. It's going to reduce the trade deficit and reduce the budget deficit. It's all wonderful, to people saying it was an absolute disaster, the most ignorant economic thing possible, and we're going to put us into a recession, if not a depression.
Right.
We're trying to see through those things.
Yes.
Where are we now after the first quarter, which was not a good GDP number? Some people extrapolated that would be a negative going forward because it was slightly negative. What happened in the first quarter?
Yeah, so a lot of people did interpret that as a very clear signal that we were headed towards recession. We pushed back against that a bit, mainly. The first quarter was disrupted a lot by the pulling in of imports, which of course changes how GDP is calculated.
In other words, they were front-running the tariffs.
Yes, they were
front-running. They import now before it gets expensive.
Front-running the tariffs, and imports aren't domestic activity, so they don't count towards domestic, the D in GDP.
Right.
But what was taking place under the surface was consumer spending remained reasonably strong, right around the levels that it has been for a long time.
Never bet against the American
2%.
consumer.
Yes, that has been a very long running theme. And so, the first quarter wasn't as bad as it looked. In fact, on the earnings side, earnings came in better than expected. Since the announcement of tariffs, most of the economic data has been better than predicted, certainly as of the announcement of tariffs. Each data point will be a little better or worse than expected, but I think where people's heads were on April 2nd versus today, we're in a much better spot economic data-wise.
It certainly, markets have reflected that to some extent. Looking forward, they're discounting the future. The American consumer was a bright spot, better than expected.
Yes.
How have personal income, which drives consumption, held up?
Yeah, pretty strong. So we look at a couple of metrics there. One is the hires rate, which is the rate of expansion of payrolls, and the other is wage gains. And taking those two together, the consumer still has ample money to spend. So there are more people employed and they're being paid more. That tends to lead to more spending.
And
so that fuel remains in place.
So that fuel's there. Where are they being employed?
Yeah, so over the past year or so, a lot of the job gains have come from healthcare. That's one of the strongest sectors of hiring. Again, over the course of the past year, when we looked at this data in detail a few months back, that was one strong underlying trend that we expected to continue. There are still high jobs on offer there. That was a sector that was highly disrupted during the pandemic with regards to hiring. Demographically, it's a sector that needs to hire more. And so we felt that was something that would continue to keep payrolls expanding at a positive rate. Right.
So here we are in the second quarter. What are the things that you're seeing now and the key points to think about the future based on the latest information?
Yeah, so we've been keeping a very close eye on 5 different metrics, and we're doing that because we recognize we're in a bit of a changing point here. We will see some negative effect from tariffs on growth. We will see some increase in inflation from tariffs. It's going to be a fairly disruptive quarter in a sense. We think it's a reset quarter, but it's important to gauge whether that's a reset or a move towards a lower base and a bad recession. We do not think it's that.
Right. It's not that, but new regime is...
A new regime.
A new regime.
A new regime. And so we're keeping an eye on 5 things. So one is looking at interest rates measured by the U.S. 10-year. There's been a lot of noise there, or foreign buyers backing away. There was a move higher, then rates came back in. When you step back a bit, rates as they sit today are right around where they've averaged over the past year. So pretty normal on
What is that,
metric.
5% or so?
Around 440.
440.
So then you move to say, well, what's happening in credit markets? Same thing. When tariffs were announced, there was a move higher in spreads. There was some concern that credit risk was seeping in. But again, you zoom back out and look over the past year, and yields on high yield are around where they've averaged over the last year. So not much credit stress.
Right. And just to help folks who aren't used to looking at credit spreads
Yes.
and thinking about where the treasuries are, what
Right.
that means, why are those two things important, Rob?
Yeah, so the first is really important because it's a couple of reasons. One is an allocation decision. So if you have high interest rates, you can hold more cash or fixed income investments, likely to hold less equity investments. That tends to weigh on the equity market. The second, and what's become more relevant recently with more and more people talking about the debt and deficit, is it is a gauge in some sense on the health of the U.S. economy and how the world views the U.S. So there was this fear after tariffs that everyone would back away from the U.S. That lasted a couple of weeks, and now we're right back to where yields have averaged, which, by the way, are anchored very much on where the Fed funds rate is right now. So I would argue it's very hard to move much away from that 4.5 Fed funds rate.
Right.
And that's where we keep coming back to on the 10-year.
So you look at the credit spreads, you look at the
Yeah.
10-year, you're not seeing any alarm bells there.
Correct.
They're somewhat constructive. What are some of the other
And then in
factors?
terms of the labor market, some of the more real-time data that we get are you get jobless claims on a weekly basis. Those just came out today. They were a little higher than expected, but same thing, right around their average over the past year.
Okay.
Then you look at how many people are being hired. So it's called the non-farm payrolls number. That's monthly. That'll be out soon. But as of the most recent data, same thing, right on average over the last 12 months. So when I step back and say interest rates, credit spreads, layoffs, job creation, all about average over the last year, so far, there will be some changes, but we're in a pretty solid place right
What
now.
about real-time economic growth indicators?
Yes. So we look at a variety of things there. We have a whole model that pulls in different regional Fed nowcasts or real-time models. We look at spending data from credit cards. We look at corporate brands that report retail sales. All of those things are pretty consistent with a GDP growth figure of around 1.5% to 2%.
Which
So
is what
consumers are remaining to spend. And that's true even as of within the past week or so when we have real-time data.
And what you've been saying for some time.
Yes.
Eventually things will settle out and the new regime will be this kind of low, slow growth, 1.5%, 2%.
Yes.
Is that correct?
Correct. And,
Okay.
and we may dip a bit lower in second quarter or third, some of the tariff disruption and noise, but the underlying trends still seem to be in place for that type of growth.
Before we talk about how that 1.5%, 2% overall economic growth translates into higher earnings and therefore a positive, constructive, reasons for the market to hold in there, if not grow. Are there any other indicators we should think about before we move over there? Have you pretty much covered the main points?
Those are those are the main and key most important ones.
Okay.
Yeah.
So 1.5%, 2%. Well, why the heck should I expect 6-7% earnings growth, which then translates into a multiple that can grow the stock market?
Yeah. So one of the really interesting pieces of research that we did was to look at all economic growth regimes and the earnings growth that coincided with those. So we basically bucketed GDP growth and said in each 0.5 percentage point, so from all the negative numbers to 0 to 0.5%, so on and so forth, what is the earnings growth that occurs around those? And when you have GDP growth in a range of 1.5% to 2.5%, historically companies have generated earnings between 6 to 8%.
And
so
how did they
6
do
at the
that?
low end and 8 at the high end. And now,
So let's just call it 7.
Yeah,
but,
call it
but
exactly, which is what we
So
what we call
how
it.
did they do that?
Yeah. So let me come back to that in 1 second because
Okay.
I just want to address the rest of the data, which is kind of interesting. So when you get growth above 2.5%, earnings tend to explode higher into the teens, and it tends to not sustain for very long. Obviously, when you get low earnings have a problem, the stall speed seems to be around 1 to 1.5%. So you could have a very slow growth economy that tends to be on the way into recession when companies are anticipating and cutting. So the sweet spot really is this 1.5 to 2.5. Anything hotter and you get a cycle, 1.5 to 2.5 you can sustain for a period of time. So that leads into your question, which is how do companies take that and translate it to higher earnings?
And as you said, first quarter earnings were better than expected.
Yes.
And do they kind of reflect this environment?
They do.
Going forward? Okay.
Yes.
So how do they do that? And why is that?
So there's two things. One is when you're in that range, you tend to have more visibility. It's more stable. You're not in this very high growth that you're worried it will fall over, and you're not rolling into a recession. It's something where you can forecast ahead and make change. But really what's more interesting is that earnings, and we measure earnings in a generic sense on the S&P 500. So biggest, most successful companies in the U.S., not surprising that they're going to be more profitable and higher profit margins than all companies in the entire United States.
They're just higher quality. They're better at what they do. They have scale.
Yes.
They're public because they have those attributes. Is that all correct?
Exactly. Yeah. And it's borne itself out in looking at profit margins. So for years and years, at least the last 5, if not 7 or 10 years, people have been talking about corporate profit margins have peaked, and they keep going higher. And as you know, we're excited about the potential for them to go even higher with some of the changes in AI and robotics. And so that's how these things translate, is the company's able to take a stable, slow growth backdrop and find ways to be more profitable going forward, especially for the largest and most successful.
They have higher top line revenue growth as well.
Yes,
absolutely. Than the economy at large.
Absolutely.
Right?
Yes.
Your coffee shop is only going to grow so much top line in your
town.
Yes,
correct.
to take the micro versus the a Microsoft.
Yes, absolutely. Indeed.
And so how long do you see that sustained period? Where do you see the market now with regards to those potential gains and therefore a nice capital return for investors over time?
Yeah, so kind of separating...
Especially where we are with the market now.
Yes, so sort of separating into shorter term, which is not really our general mindset, but in my view, we are a little bit overvalued at present, just given all of the uncertainty over the next couple quarters, potential for numbers to surprise a little bit on the up or down side.
Sure.
And it's a difficult environment to forecast. But when we look out longer, over a 3-year period, which is our forecast horizon, we see relatively stable earnings growth on the order of 7 to 8%. Mm-hmm. And we're anticipating no real change in valuations. So stocks aren't really cheap here. They're not terribly expensive. But if we have a backdrop where interest rates come down naturally towards a more normal level over the next few years, we think those valuations can sustain. And the way you generate gains in this environment, we think over the next 3 years, is from the earnings side. So in that 1.5% to 2.5% GDP growth, 7% or so earnings gains, that carries stocks higher. And maybe there's a little upside to that if we get some kick from AI and profit margins. Maybe there's some short-term downside to it if we get more disruption from tariffs and geopolitics.
And so that doesn't include dividends.
Correct.
So 7%.
Yeah, plus
or minus
1.2 or 1.3.
Exactly. Great. Thanks, Rob.
Great. Thanks, Rick. Good to see you again.